Okay, so today we're going to go through precedent transactions. I want to complete the valuation analysis, and then I'll post the final model. We're going to go through that today. Okay, so we're mentioning in going through the three kind of valuation methods: comps, PPaids, and Dcf. PPaids we're doing last. PPaids, they each have their benefits and flaws. The PPaids are the precedent transactions. The benefit of that is it includes a premium, right? So when you're looking at an analysis like we were looking at yesterday, where you're trying to figure out, okay, how much of a premium should one company pay? This includes that, because precedent transactions, in terms of what it means as a measure of valuation, gives you a perspective of how much an entity has paid for a company, as opposed to comps. Comps is how much would somebody pay for a stock, which gives you a very, very current value because it's based on the stock market close. This is, let's look at past transactions similar to the company that you're analyzing. And if somebody's paid 3 times revenue for a company like yours, your company should be worth 3 times revenue. That's the idea. So it's similar in nature to comps in that it's a table of multiples. It's different in that it's not about what somebody would pay for a particular stock. It's what an entity would pay for the entire company, just a different perspective on it. So although the benefit includes a premium, there are some major drawbacks. One is a lot of times it's difficult to find transactions that represent an acquisition of your company. Walmart's a great example. Walmart is just so big. It's $250 billion. I don't know if that's ever happened, an acquisition of a big box retailer. 2, if you do find transactions, you're going to have to, Google around and look for news runs and headlines. If you do find transactions like that, it's tough to find the data sometimes, because a lot of times the acquisitions are of private companies, or if it's a public company and it's acquired, sometimes it's difficult to find that information anymore. So a lot of times you'll see this table, this precedent transactions, a lot of NA, NM, NA not available. That means a lot of the multiples have been are blanked out, and you'll see a lot of tables like that where you just don't have a lot of that information. And then the second problem, or a troubling thing about precedent transactions, is the analysis is always dated. Right? The transactions have happened. We model out the transactions based on announcement, and if they've closed, closing usually happens 6 months to 1 year to almost 2 years. So it's a historical analysis. These multiples could have represented a market environment that is not similar to today. So actually, a lot of times the precedent transactions analysis is just thrown out. But it's good to do. It's good to know how to do. So in this example, we've found a bunch of transactions that were as close as we thought we could get. Not super close, but as close as we thought we can get. And I'll show you how I found them, or I'll tell you quickly how I found them. One I just kind of Googled around, like acquisition, big box retailer, or acquisition. And it was very difficult, but what kind of saved me in a sense, was the fact that yes.
You always find those from Google, or
always find those
transaction. You always find those information in Google, or probably just have to find it in some paid database.
Yeah, we'll go through those methods. We'll go through those methods in a second, but Google's going to be one, maybe a paid database. Hopefully they'll have financials or annual reports. But yeah, we'll go through the techniques of how to dig it up in a quick second. But just in general, just to find, first of all, even before the data, which transactions are relevant, you're going to have to do some word searching, some news runs. And has anybody heard of a fairness opinion? Have you had to do it in the internship? It's not very common in a boutique firm. Maybe, I guess it is. I mean, usually boutique firms it's not really a deal, right? What happens is, and we'll start looking at transaction documents. We'll actually look at a transaction document for this comp, but the next models that we do are transactional. All right? We're going to be working off of not necessarily just the annual reports, but a transaction document. So if a transaction is announced, they'll usually file a proxy or an S4 or some other document, which is it's really for the shareholders to explain financially and from a subjective perspective what the transaction is about, really to garner approval. If you're a shareholder, you have to vote. A proxy is a solicitation to vote in approval of, let's say, the merger or the acquisition. So if a merger has happened, you want to look for a proxy. And a proxy usually, hopefully, contains financial information, standalone, and sometimes merged financial information, which will be helpful, and we're going to go through how we use it. It also contains an opinion. It's usually called an opinion of financial advisors. It's a fairness opinion. So oftentimes in a merger, you have, as you guys know, you have a banker that represents the acquiring company. You have a banker that represents the target company. And when you're negotiating either for yourself or for the shareholders, most of the time, the banker that represents the acquiring company is going to be in favor of the acquiring company, and their valuation might be a little bit biased, or there's that fear, or there's that thought out there. And the banker that represents the selling company might be biased in terms of maybe having the valuation be a little bit more positive to benefit the selling company. So there's usually a third banker that gets hired who's supposed to give an unbiased valuation, and it's called the fairness opinion. And usually I remember I did it once at Morgan Stanley. Actually, I don't think I ever was staffed on one, but I remember one happening. And usually they're hired at the very last minute, and you have to have super attention to detail because everyone's leaning on you to have the most accurate valuation. And so it's kind of one of the most painful processes to go through if you have to be staffed on a fairness opinion, because you're up all night. And, you usually have 2 days to do it. Do the whole model, be super detailed, can't have any mistakes. Whereas if it's like a 6-month deal, you've seen if the model's ongoing, it's getting passed around, you have time, you're updating things. It's just not the time crunch. But what's good about a fairness opinion for us is we can use those numbers. They'll have suggested projections, they'll have multiples, they'll have things. So the fairness opinion is a good place to go to for transactional information. So we're going to look to the fairness opinion. And so the fairness opinion, sometimes if the company is good, they'll have their own comps in there. You've seen, comps and precedents, and this is like banker stuff. It's usually not in financial documents because they're not GAAP requirements. But in a fairness opinion, you might see comps. And so I found a fairness opinion that actually had listed every single one of these deals. So this kind of saved me in terms of doing precedent transactions. So go to fairness opinion. So I found one, I forgot which deal I found. I kind of Googled big box retailer acquisitions. And I was looking through one of these documents, like maybe it was like, let's say Bain Capital bought Dollarama. Dollarama was a public company. Bain Capital is a private equity fund. And let's say I was looking up Dollarama, and I saw a fairness opinion in there, and they did their own precedent transactions, and they listed all these. I said, perfect. They listed these as similar. They didn't have the multiples and stuff, but they listed these as similar transactions. So we went in and pulled everything up. Okay, so now I want to go through the process of pulling up this acquisition of Dollar General by KKR in 2007. Okay, this is super dated. I mean, this is almost 10 years old. Even when I wrote the book in 2013, this was dated. This was the last acquisition of big box retailer that I could find. Remember, back then, 2013, 2009 kind of destroyed the whole MA market, and it really kind of started picking up in 14, 15 from there. So it was tough to find. Yes, that was the article I was supposed to send you yesterday, and I had forgotten to, but I want to send you that. And Cortez, if you're online, I never got back to you about when you're back in class or whatever we could talk about. Yeah, and I pulled up the article about they said the valuation wrong or something about that, and then I never ended up reading it because we got into the Dcf analysis, and then I never came back to it. So, okay, well, poor timing. Cortez just arrived. All right, so let's say we found a note, whether it's by Googling around or by someone else's fairness opinion, that there was an acquisition of KKR by Dollar General. Now, to Lily's question, if the company is private, we are a little bit in trouble. And you can see here there's a lot of NMs, no, not available. A lot of these things I just couldn't find anything for. You could go to the company website. Hopefully they'll have an investor section. Even if it's not public, they might have like a private, where they'll have like a presentation that's supposed to solicit some investments that might contain some financial information. You can maybe Google around. Some companies like Morningstar, he's not here, Morningstar would have some relevant information. Or as Liz suggested, if you had Bloomberg or Capital IQ, you could pull information. The best information to get, obviously, is from the actual 10Ks and 10Qs if the company's public, right? Or a transactional document. Okay, so for Dollar General, the first thing I'd look for, even if they're acquired and not private, they still should have lingering documents. So let me go to sec.gov, and I'm going to pull up company filings. I'm going to look for Dollar General. and see what they have, okay? So look for Dollar General, company name, Dollar General. And I'm going to see what comes up. Here's the Dollar General. I know this is the public company because there's an SIC code attached to it. And okay, they must have been brought back into the market because here's 2017. They must have been re-released into the market. I don't know how they're doing. But you want to search prior to the announcement date, which was 2007, July 7th, 2007. This is about, so I'm going to search prior to that date to see what documents were available. And you got to dig. You're going to go page by page. And you'll kind of know what type of report. You can look at the descriptions. This is a securities registration termination, so that's not it. 8Ks are just current reports. They would just announce anything. It could be buried in an 8K. It's just an announcement of anything. Here is acquisition of beneficial ownership. That could be it. Proxy, definitive proxy soliciting materials. Okay, so it's probably going to be a proxy. There are 3 proxies here. I forgot which one actually contained the information. If you click into one, I remember some of them just didn't have anything. You'll kind of pretty much tell right away. I'm going to scroll up. Transaction. This is private investment, KKR, Dollar General, sources and uses of funds. This is it. It says, what are you talking about? Right off the bat, right up to the transaction, the merger, the investment by KKR. It says right there. Acquiring Dollar General, and right here, sources and uses of funds. So we're going to talk about sources and uses of funds in an acquisition. This is going to be a big component to M&A and LBO. Sources and uses of funds is how much are they paying and where's the money going. Okay. So, yeah. So we want to run the transaction as of announcement. The purchase price, you might notice here, like for example, the super value, there's only one number here, and it's the enterprise value. That was probably received, I mean, I did this, but I forgot how. That was probably received in the press release. So in the deal announcement, right, and I told you I found some deal announcements. That's right. So the first thing I did was I Googled deal announcement. They will most likely have the purchase price in there. So, we're going to have to read between the lines and look for clues in terms of, is that purchase price an equity value or an enterprise value? In other words, do they include the assumption of debt or not? So we're kind of jumping the gun a little bit because we're going to talk about this in completely in the M&A part, and we're going to go through press releases and stuff. Yeah.
So someone, they have both, like market value and enterprise value.
Yep.
So that means in the same time, the sold by stock market for the market value, and also the purchase to the transaction.
Yep.
To the M&A for the enterprise value.
Mm-hmm.
So the price is just different. That's why they have 2 prices, right?
Mm-hmm. Yeah, that's exactly what I'm trying to explain. Mm-hmm.
On the most right side, the enterprise value, there's 3 revenue, EBIT, EBITDA. All those are explained. The second column, the enterprise value, are the how many times.
Yep, that's right. Yep, we'll get into that. We're going to talk about that. We're going to calculate those now. Yep. So, in other words, as you were asking, and this is just what I wanted to get into, is a lot of times you'll see like a press release. Company A has announced to buy Company B for, $15 million, and the question is, well, is that market value or enterprise value? You'd kind of have to read between the lines. So there are a few buzzwords. First of all, they may not even assume debt. So when you make an acquisition, right, the company pays a purchase price, which is a price to convince the shareholders to give you their shares, but you buy out the shareholders. You may or may not have to raise additional funds to buy out the company's debt. So we'll talk a little bit more about that in M&A, but just kind of know. And so when they announce a purchase price, sometimes that includes the payments to the equity holders and the debt holders, or sometimes it's just the purchase price. And sometimes it's difficult often to tell, but there are clues by looking at press releases, by reading between the lines. If you read something like total consideration means equity and debt. It's the total consideration. It's just not the purchase price. When we look at Heinz, for example, they're going to say Heinz is being acquired by Warren Buffett and 3G for a purchase price of $18 billion, including the assumption of Heinz net debt. So they kind of clarify it completely. In the Office Depot Office Max, they say Office Depot Office Max, Office Depot is agreeing to acquire Office Max for $27 billion, and they don't say anything about the debt. So we had to dig further. And actually we found out when we dug further, we found out that the $27 billion did not include the debt because we found a fairness opinion that actually had market cap and enterprise value. And we found other things. So we found a balance sheet, a merged balance sheet, where we saw that they included debt in addition. So you kind of have to read between the lines. If they don't say anything, you'd probably be safe to assume it's a market value. And then you have to kind of go in and look for debt and add it to the market value. And if you're wrong, then you would just kind of remove it.
How did you go about checking the fairness value? Was it available somewhere?
So the fairness opinion?
Yeah.
So right in here. So here it is. So you would go to the proxy.
So that company would have an 8K or whatever there, maybe buried in?
Yeah. Actually, I don't know if this company has it. We actually didn't need it because this was pretty. The top table is pretty helpful enough. Anyway, let's see. And we'll do this more in the actual acquisitions. Financial statements. No, this is really abbreviated. Pro forma financial information, exhibits. You'd have to do a little digging. This one doesn't have it, so I'd probably go to the next proxy and dig through it. But it's in one of the proxies, if that's your question. That's where you would find it.
So, Paul, so you said that sometimes they include debt and just the purchase price. So is that just the equity value?
Is what just the equity value?
Because you said that sometimes like they just they don't really factor in raising debt, but they just announce the purchase price, right? Would that just be the equity value that they're paying?
The purchase price?
Yeah, purchase price.
You got to read between the lines and figure it out. Yeah. So by default, it is more than likely if they just say they're buying out the shareholders, they're paying purchase price. If it's just, then that's just equity value.
That's the equity
value. Yeah.
But then and when you're doing it, you have to add back the debt to get the enterprise value.
Yeah. Yeah. So let's do that now. So for example, here they. Why don't they say that?
Why they name it enterprise value?
Why don't they? Or why do they?
If they include the debt or not.
If they include the debt, they'll name it enterprise value for sure.
Well, if they didn't include the debt, they still call it enterprise value?
No, they wouldn't. The problem is, I see what you're asking. The problem is when the media reports it, they're not saying market value and enterprise value for whatever reason. They're just not using those terms. Okay. They just say purchase price. And so we have to kind of figure out, okay, well, what is that really representing?
Oh, so when they list it there, even it says underneath the enterprise value, but it can mean that just market value or enterprise value. No,
if they list it as enterprise value, then it's definitely enterprise value. Oh. My point is, oftentimes they won't be that clear. Oh. And if they're not, then you have to face that issue. But if they say enterprise value, it's definitely enterprise value. I wouldn't second guess it.
Okay, but in that chart, everything is listed underneath the enterprise value. Third, yeah, on that column, that means for sure it's enterprise value.
Well, yeah, because I put that together. Let me see. I don't know. I actually wonder. Super value Albertsons. I wonder how that came through. I wonder why was it super value? Albertsons acquisition. Let's see. I'm just curious. Let's see what. Okay, here it is. This is 2013. That doesn't make sense. Maybe this is just an old. Albertsons announced the agreement. Okay. I'm surprised because this is 2013. Oh, actually, was it 2013? Hold on, let me go back to this. No, this is 2006. Super value Albertsons. It might not be up there anymore. Here we go. Super value by Albertsons for $17.4 billion. Okay, that was it. So let's see. Here we go. So agreed to sell. It says right here, Albertsons agreed to sell the firm for $74 billion in cash, stock, and debt assumption. So they actually said it right there, that it includes the debt. So enterprise value. That's what I'm saying. They're not going to say enterprise value or market value, okay? So it sometimes won't always be that clear. And we'll see when we look at some other, well, here's another one. Bon-Ton Stores and Saks. I never heard of that. Bon-Ton Stores, Bon-Ton Saks. Let's see if that comes up. Bon-Ton to acquire 142 stores from Saks for $1.1 billion. Is that right? 1.1 billion? Let me just see. Yeah, 1.0473. Okay, 1.1 billion in cash. I'm guessing I had to dig deeper because I didn't put 1.1. I got very detailed here, 1.047. So I must have had to pull it up. But let's see if there's any clues here. It doesn't say. We look forward to Bon-Ton Pay. Well, okay, right here. Perfect. Bon-Ton Pay 1.1 billion in cash and assume capital leases. This is debt of 35 million. Yeah, and assume capital leases. So this is a clue that I must have dug deeper. This is a poke company. I must have went to their filings, but this is a clue. Assume capital leases. Capital leases is looked at as debt. So they are assuming debt. So that was a red flag for me to say, let me dig deeper and get into the specifics. And for some reason, I came up with 104.7.3. I must have pulled up a report. I must have done just what I'm doing here.
We have to read a bunch of things later, and we need this type of.
You got to do a lot of research for precedent transactions, and that's one of the difficulties. It's just time-consuming to do the research.
How much the resource?
Hmm?
How much was the resource? Where you get it?
I mean, if you're pulling it from SEC filings, you know, yeah. And if you don't, you know, like in maybe like this case, if I had just pulled it from the press release, you just got to take the, if it's from the company, you just got to take that for what it is. And that's one of the drawbacks, is hard to find the information. Sometimes it's difficult to get. Yeah. Sure.
If you do have a paid database, is that trustworthy? Yeah.
I would always, like comps, I'd always try to get back into it from the actual reports if and when possible. Yeah. So here we got real lucky because they listed the transaction, they listed the purchase price, 7,003.6. Okay. Now, first purchase price, they weren't very specific. Is that equity value or is that enterprise value? What do you guys think? Could be either, and we'll see when we go. You got to kind of figure that out. So could be equity value or enterprise value. How would you know? How would you be able to figure that out? How do you know that though?
Purchase price is really precisely.
Right, but that's what I said. But not always.
Oh.
So how do we know? And the uses is not the debt you want to be looking for. The uses is how they're going to pay for it. That's not the target's debt. I'm sorry. I'm thinking sources. The sources is how it comes funny. The uses is what you look for. And yes, you are right. I'm sorry. If it's because debt's listed in the uses, they're not going to double count. It's obviously not part of the purchase price. And Beatrice, yes, you're right. It usually is. Sometimes it's not. It's a trick in buyout, so we're going to have to look at that, and we'll look at other ways how. So this is the equity value, 7,003.6. So we're going to list right in here, market value 7,003.6. The way I do PPaids, some people might have a problem with it, but I hard code directly. I do the table right here because it's super. You're pulling things from different, and I footnote everything. I would have noted from page 2 of SEC filing, and I'd print the filing and circle where I got it from, because so if your associate's digging through it, that's the right way to do it. Okay, 703.6. The enterprise value is that plus retiring the target net debt. How do we know what the target net debt is? As you guys said, it's right here.
No, this is the practice statement, right? This is what?
It's proxy report. Yep. Here it is. Refinancing existing indebtedness.
And then other repaid?
Yeah, I would do both. I would do both. Yep. 219.4 and 67.7. These are the debts, indebtedness. So I'm going to do, what I'm going to do is I'm going to enterprise value equals the year before. I'm going to plus 219.4 plus 67.7. Okay, a little bit more crude. Some people like to do underneath and then link it up. I like to put it right in here, footnote, everything where I got everything. Okay. So 7290.7 is the enterprise value. Now we need to find the underlying data. We need earnings, revenue, EBIT, EBITDA, right? We got to find their income statement. So hopefully the proxy will have it. It should. And if I scroll down, there it is. Sorry, that's the balance sheet. More balance sheet stuff. Here's the income statement. Okay, so a couple things. So they list the historical income statement, and I've checked that this is as of February 2nd, 2007. Okay. Then they show adjustments that get you to pro forma. You do not want to use pro forma numbers. Pro forma is after the transaction, and we'll talk about the transaction adjustments that need to be made. This is, for example, if the acquirer paid down the debt, they're going to eliminate the debt, the interest from that debt. If the acquirer raised their own debt to pay for the company, they're going to have new interest. Those are the adjustments they want to make. You don't want those numbers, the acquisition, post-acquisition numbers, buried into the multiples, because you want a picture of how did the acquirer look at and value the company before they bought it. So you want to look at the most recent historicals, basically as of the announcement date. You don't want post the acquisition numbers. You want pre-acquisition numbers. Remember what we're looking at. We're looking at, based on the purchase price and based on the enterprise value, how did the acquiring company value that entity? And so when you read purchase price, and you have to think about, is purchase price a market value or is purchase price an enterprise value? It's an important distinction to make because we're going to do market value and enterprise value multiples. But when I say market value multiples and I say market value, I don't mean market value like market capitalization like you would in comps. Market value in this perspective is the price paid, because that's what we're analyzing. How much do they pay for the company's net income? How much do they pay for the company's EBIT or EBITDA? Make sense? Okay, so historically, here are their sales, 9169822. So let's link that in. So here's the revenue, 9169822. 9169, I want to be on the same page with units, so it's 0.9169822. Okay. And now because this is an enterprise value multiple, I'm going to take the enterprise value, enterprise value divided by that 9169822. Okay, remember, the enterprise value, when you're looking at underlying metrics for multiples that are above the interest line, or in other words, before debt, we have to take the market value and add back debt. We have to compare, we can only compare those metrics with enterprise value. We talked about this with the comps, right? Good? Okay, notice an X appears. All right, I want to just do a quick little side lesson on custom formatting. This is a good time for it. A lot of times, although Excel, if you hit Control-1, is a quick way to bring up the format box, although Excel has a lot of nice kind of formatting options, it might not have the one for you. And so there are ways to amend. Okay, so for example, I want an X there. I just take, first of all, 0.0. Anything after the decimal illustrates how many decimal places you want. If I wanted 2 decimal places, I put 0.00. And then I can put an X afterwards. Okay? And that gives me the X. This is how I had gotten, I'm going to go back to my model for a second. This is how I had used custom formats for the years. I don't know if you've tried doing this. What's nice about the way this model is set up is if I never needed to update it as a template, I just have to change the year in one place. I have to change this 2010 to 2016, and it'll update everywhere. Why? Because everything is linking into this. 2017 equals 2016 plus 1. You might have noticed if you try to hardcode 2016A, the math won't work. It won't. 2017, taking the year before plus 1, won't work if 2016 is actually typed in as 2016A, because once you type in 2016A, it's no longer a number. It's a string. It's text, and you can't just add 1 to text. So that A is actually a format. If you look into the cell, it doesn't say 2016A, it says 2016. So if I hit Control 1, you'll see general \A is a way to add, you have to memorize this or write this down, to add text to cells and have it come up as formats. So general \A, I could put B, I could put PF for pro forma, E for estimated. Those are formats. Okay. What you can also do, okay, is you can do things like adding colors to formats. So if I want this cell always to be red, I'd put in brackets red. Okay, it comes up red, right? Or I can make it blue or yellow, right? Blue, right? Or yellow. Okay. If you put a semicolon, anything after the semicolon is how you'd want a negative cell to be represented. So let's say, I don't know if I knew in banking we used to always want percentages, things like that are represented as percentages. And the percent, we always wanted the percentage inside the parentheses. For some reason, the percentage format has the percentage outside the parentheses. There's no way to fix that, except in custom formatting. So a negative number is going to be shown as a percentage. Say if I had negative 2016, there it goes. A percentage inside the parentheses. I can make the negative number yellow if I wanted to. Oops. Okay. And positive numbers blue. You can have a third option, a third colon, demonstrates how you want an absolute 0 to be represented as. So sometimes you might, without that, you might see a 0 and you'd say, well, is that actually 0 or is that 0.000056? So a third colon, accountants have a dash, meaning dash is absolutely 0. And I can make that, orange if I wanted to. No, maybe they don't have orange. I tried to get ahead of myself. Yellow, blue, I don't know what else. Red, I thought they had orange. Okay, it's 2016. I'm going to go back to this, and I'm going to go back to my normal rules. And you can play around and kind of figure out some other things as well. I think that's a helpful start. Oh, 2016. I hit a period. You can see how dates are formatted. There's several ways to do it. M/G/YYYY, and then you can kind of play around from there. If you want the month, 3 letters, the first letters of the month, just put MMM. You can do MMM/D/YY, just the last 2 years. You can kind of, I think, guesstimate. Here's how to put hours. You can kind of just play around with from there how to make adjustments. But I think those are the more common ones. I'm going to get back to okay. So now we have revenue let's go down to EBIT and EBITDA. So if we look at the historical analysis, we have net sales, we have COGS, we have gross profit, SG&A, operating profit. I don't see depreciation here, so I have to assume that depreciation is buried in here. So this is EBIT. And I got to find depreciation and add it back. This is my EBIT, 248276. It's got to be. Okay, so 248276. So I'm going to use create my EBIT multiple by taking enterprise value divided by 248 point, right? I'm going to just adjust for the units, 276. And there's my EBIT multiple, 29.4. Okay?
Bruh, you have a dance.
248.276. Okay? And so for EBITDA, see, this guy's making all that noise. Okay. For EBITDA, we'll have to dig up the depreciation. Okay, so I can do a word search for EBITDA. Let's see, maybe there's cash flow. No, these are operations. These are more operations, just different time period. More operations. Nothing helpful here. Here we go. Okay, well, here's depreciation and amortization, fiscal year 2007. I can add 200.6 to the EBIT, but it's going to give me this 448.9. Actually, they did it for us right here, EBITDA. They made it really easy. If this line wasn't there, I would have added this 200.6 to the 248, and that would give you 448.9. They give you the same number. So we're going to use 448.9. Okay, and so the EBITDA is enterprise value divided by 448.9. So I use this is just it's just all about data mining, unfortunately. Precedent transactions. That's why doing PPaids, a lot of people, it's probably like the worst thing to do. Okay. I wouldn't adjust any adjustments they make. I'd be biased against adjustments. I always think that adjustments that they make are going to be in favor of the analysis of the company. I would just do straight reported EBITDA. You have a question? That's the announcement date, February 2nd. That's the closest to announcement date. Yeah, and this is in line with February 2nd. The announcement is February 6th, so this is as close as you can get. Yeah. Okay. All right. One more left. Net income. So let's go back up and to our February 4th fiscal year. There's net income right there at the bottom, 137,943. This is going to be related to market value, market value net income. So equity value to earnings, market value net income. We're going to take the market value divided by 137.943. Okay. There's the thing. Real simple. Just dividing.
Just with the you shouldn't take adjustments, right? What happens if you have an EBITDA and they put things in EBITDA of how they want to calculate it? Do you have to take things out in that case to kind of standardize it, or?
Yeah, I mean that's what they did here, right? They had an adjusted EBITDA and like to take the base EBITDA.
So you added everything, or you like how would you?
Well, if they're doing that, if they're making adjustments, and you know they're making adjustments, they're going to show you the regular EBITDA, right?
Right.
Yeah, you just got to take that regular EBITDA. Yeah, yeah.
Thank you.
Okay. Now, what do we do with this? Let's say we did this for every company. What does it mean?
Gives us an idea of how much our company should be worth.
Yeah, true. How? Like, I'm talking about what are these multiples? How are you analyzing it? What do we got?
Take any one company, for example, we can start from there and say, hey, Whole Foods Market, for example, acquired Wild Oats Marketing. The market value was so. but what they paid was the multiple. So
Mm-hmm.
that's where you get an idea of they paid 0.04 times the earnings
Mm-hmm.
for that company
Mm-hmm.
compared to the market value.
Mm-hmm.
And for enterprise value, it's anywhere above 0.6 times the revenue, 37 times the EBIT.
Mm-hmm.
So that kind of a multiple gives you an idea of how much they paid. But in the bottom where you have the high, medium, and low, and that's where we usually get the summary
Mm-hmm.
of how much are they usually getting.
Yeah, that's a good walkthrough. So how would you summarize it then? How would you summarize the analysis? What are we taking away from here? Yeah. Yeah, but what, and then let's get into more specifics now. So like what, if we want to apply this to the valuation of our company, what multiples will we use? How do we look at that? How do we walk through that?
The EV or EBITDA, start from there. I would say from the Precedent transaction summary that we have, the company was sold anywhere from 11.7 times EV over to 16.2.
Yeah.
In the median is 13.8, so you can expect somewhere else.
Yeah, that's a good range. We would start here. Why would we not? I mean, we could have taken equity value to earnings. Why didn't we? Or why didn't you suggest that?
We're acquiring the company, we're taking over both equity and the debt.
That's true. That's one good way of looking at it. Also, remember we mentioned with the comps, these are all over the place. And a lot of this data isn't available because, a lot of companies would show like EBITDA, maybe even the top of the income statement, but a full income statement is tougher to get. And remember, capital structures of companies are different. So when we looked at the comps, we talked about how or why the comps range for net income, companies, it was like all over the place. But for enterprise value EBITDA, it was a little bit tighter. It was like 8 to 11. And that's because some companies have a lot of debt. Some companies have a little bit of debt, which will impact your interest rate, which impacts your net income, not EBITDA. Some companies have a lot of depreciation. Some companies have a little bit of depreciation. EBITDA doesn't have any of those impacts. EBITDA is before all of that. So if you look at EBITDA, it should be more in line. So that's why a lot of times we just take the EBITDA multiples, enterprise value EBITDA multiples. And you can prove that here. Enterprise value to earnings is all over the place. Enterprise value EBITDA, it's a little bit more straightforward.
Isn't that kind of ignoring all the risk about the depreciation or
Yes. So that's the other side of it. So good point. So you do have to take a lot of consideration into this. I mean, if you're going to buy the company, and let's assume you're going to wipe out the debt and, anyway, then it doesn't matter. Look at EBITDA. If you're like an investor trying to invest in the stock, yeah, you want to still look at the PE because, when you invest in the company, everything's going to stay in place. So you got to use what I'm saying and kind of think about, well, what type of analysis it is. And that's why a lot of equity research reports sometimes you're still focusing on EPS and PE and things like that. So, okay. How do we apply this? We had 3 methods of valuation: DCF, PPaids, comparable company analysis. How do we apply this? Well, if you go to the right, we have this football field where everything kind of gets laid out, okay? And when looking at, like, let's say the comparable company analysis, now, I think for you guys coming in, this comps analysis, I didn't open the model that was complete, but even without this row, if you remember, we had concluded, I think it was like 8 to 11 was the kind of fair range. Let's see, I think it was 8 to 11. We talked about this last week. It included like 8 to 11. I'll email you guys the updated one with that. So I think we had 8 to 11. And so the question is, using that, 8 to 11, what we want to do in the football field is we want to take each of our 3 methods and draw out a range of multiples that we're going to use to apply to Walmart's multiple. So for example, in the comparable company analysis, what we're basically saying is if its competitors are trading at somewhere between 8 to 11, that range, Walmart should be trading within that range. And you know what? It kind of actually does. It's at the low end of the range. But what would happen if Walmart is trading at the very low end of its comps? What would its stock price be? What happens if Walmart is trading at the very high end, at 11 of its comps? What would its stock price be? Because compared to its competitors, it could be anywhere within that range. So that's what the football field is trying to say and trying to explain. And we're going to do that with every analysis, more or less, and somehow, and slowly come up with an expected stock price. Okay, so for example, what this football field is saying is if the multiple was 8, what would the estimated stock price for Walmart be on the low end? On the high end, if the multiple was 11, what would the Walmart stock price be? So we have to take the multiple and back into and build up to stock price using Walmart's financial information. So to get from multiple to enterprise value, what do we do? How do you get from multiple to enterprise value?
You divide. So you have to take the numerator.
Multiply.
The enterprise value. So for the multiple.
Multiply. So let's take the 2012.
You multiply it with that and make it generate.
Yeah. So we take the 2000. We're going to take 2012. We're going to take the last report out of EBITDA. You could take last year's. You could take LTM. You could take next year's. It's kind of up to you. It's not really going to change that much, but you just have to take one measure and just be consistent all across the board. So you guys say, okay, I'm gonna base this on last year, LTM, 1 year out. Just label it and be. I've seen it done all different ways. And so I'm going to pull the 2012 EBITDA using the income statement. So here's, I was going to say, what happened here? I was playing around with the formatting here. The 2012 is column F. Let me just change it. 2012 EBITDA is column F, the 34688. Okay, you guys have 2012. I have 2018 because I was playing around with the dates. Okay, and let me just go back and fix this here because I was giving you the formatting list of 2010. There. Okay, so 2012 EBITDA. And as Drew suggested, we multiply. So we take that EBITDA times the multiple, and that gives us our enterprise value. So if Walmart was trading at 8 times, not 8.6 that it's trading now, its enterprise value would drop to $277 billion. And the question is, well, what would its implied stock price be? So we have to continue to build. Good?
Yep.
Now we got to get from enterprise value to equity value. How do we get from enterprise value to equity value? Subtract. Yeah. So net debt, we have to calculate net debt. Actually, we already have it in the DCF, so let's not, we don't have to I hate recalculating the same number several times. So if we go to the DCF analysis, there's this net debt, the 54230. We've already calculated it 1,000,000 times, so let's just pull it in from the DCF analysis, okay? That's the net debt. And then the equity value you would subtract. Okay. Oh, interesting. Okay. And then to get the share price, what do? We got the market cap, implied share price, divided by shares. So we got to get the diluted shares. Again, we could just pull it from DCF. the 3366 and divide. So basically we'd expect Walmart could go down as low as $66. That's the idea. We do it again on the high side to see how high Walmart's stock price can go.
Pretty much the same calculation assumed in the 11 times, right?
Yep. 5 deads. Okay, I thought something was funny. I don't know if you have different numbers for debts. Do you have different numbers for debts? If you go here, I remember we talked about this and I fixed it. When calculating net debt, guys, if you can go to the Dcf Analysis tab, column O, it's the total debt plus non-controlling interest minus cash, and I had accidentally pulled F20 as actually short-term debt, not cash. I remember talking about this in class, and somebody caught me. I think it was you, Alex, or somebody said, oh, you're pulling the wrong number, and I thought I replaced it with cash. Maybe I didn't save it, but it's not minus F20. Obviously, it's minus F8, which is cash. So I don't know if everyone had the same number. Maybe I know somebody mentioned it. I know we caught it in class, but maybe it didn't save, and then you're pulling the one from the cloud, which is still has that error in it. So okay, so 51727, and that flows all the way through. Okay. Yeah.
Someone has all the formula or all the like multiple, because sometimes when you talk about this, I feel it's hard to react that fast.
Yeah, I mean, listen, the book goes through it completely. There's every single formula, step by step, right?
But it's in different pages, so I will just summarize it in one.
Yeah, I mean, and this is why I think it's helpful if you follow, like every time after class, I tell you the exact pages that we talked about, you know? But another thing is, if you do, I don't know if this is helpful, Control tilde shows you in one shot in every single formula
What's that?
in the model. Look at that. Maybe that's Control and the little tilde. So if you want to pull the model, and you can actually even print this, and do Control tilde, that shows you every formula in one place, if that's kind of what you're asking for. So right there. And actually, as an instructional tool, I actually never thought about doing it. I can just leave it like this for a few minutes so you can see all the formulas. Maybe that's what you were saying, Lily. That's actually a great idea. I can just go into this mode so you guys can see. Because I get a lot of people say, kind of look at this, kind of look at that, kind of look at this. Yeah, tilde is this little squiggly line. The very top left, underneath escape. Yeah, yeah, and actually, Lily, I'm glad you said that. I never even thought of. I can just kind of at appropriate times, because I do go fast at times just to pace with some people that I feel like already have it. This is a good just to leave it like this so you can see every single formula, so you don't have to feel like you have to ask me along the way. So hopefully this is helpful as well. That's a good point. Yeah, Alex.
So what's the what you're doing here? Let's say like EBITDA wasn't the appropriate enterprise value of EBITDA wasn't the appropriate multiple to use, and we were using P.
Yep.
And will we have to start from net income and build it up all the way to the implied share price? Or
Yeah, well, the PE multiple times the net income is enterprise value.
Is the enterprise
Yeah, you don't have to build
Wouldn't
it.
that be equity value? Because I thought that
Is the equity value.
Yeah,
You're right, yes. Yeah, you would just build it up a little bit differently. Yeah, good point. Okay, now we have to do this again for the high end. So it's the same information. Okay. So I'm just going to, so we have to take 11, multiply it by the EBITDA. I'm just going to pull the EBITDA from the left here. I don't have to go back to its source. And you have to kind of just repeat the pattern. I'm going to multiply again. So if the idea is if Walmart was trading at 11 times, a lot higher than now, it'd be $381 billion. Okay. And then we can pull the formula from the left for the debt. And you can subtract to get to market value. Okay? Same idea. And then we divide by shares to get the implied share price. That's the process we have to go through, you know, and we'll do it for prepaids, we'll do it for the DCF, we'll do it for the 52-week high and low as well. For tracking purposes, we will talk about that.
Yeah, and also a question for Wolf. You're using net debt in your calculation, which means you're taking out cash from it, right? Is it because you're assuming that cash, like in the book, it's not going to produce like as much of it?
Operating asset. Yeah, we just want operating assets. Yep, absolutely. Good. So then we take the shares. Again, you can pull it from the left and divide. And so the idea is that Walmart stock could be trading between 67 and 98. That's a wide range. It doesn't really help us when the stock was at 78, but this is where we want to compare this to the other methods and see if there's some sort of overlap. Okay. So I'm going to leave it at this. Let's take a little break. If you guys need to catch up here, you have it right here. And we'll continue with finishing up this analysis. Any questions so far?
Yeah, one more question.
Yeah.
So you always use like whatever company you're analyzing is like enterprise value or EBITDA multiple. Would there be a situation where you use like competitors' EBITDA multiple or sorry, use a competitor's EBITDA or use like their earnings, for example?
No, because then you're valuing the competitor. Yeah.
Okay. Thanks.
Mm-hmm. Anyone else? Okay. Be back in 10 minutes. Now that we have the comps, we got to kind of do the same thing with the rest of the analysis. Precedent transactions is pretty identical, but we got to come up with a different range, right? And we had mentioned a range suggesting somewhere around, I believe it was like 12 to 16, right? That's what you're kind of saying. You know, so if you a lot of people are very specific and link it into the analysis and take the high and the low. A lot of people just kind of eyeball it and say, listen, I'm just trying to get a general range. So 11.7, I'm going to round to 12. And then the high, 16.2, I'm going to round to 16. So I'm just going to do 12 to 16. It's kind of up to you. So pressure transaction low end is 12, high end is 16. And we're going to apply the same method just to build this up to an implied stock price, right? So I'm going to multiply that by the EBITDA to get enterprise value. I'm just going to pull the EBITDA from the left. I'm going to multiply. I'm going to subtract from the debt to get equity value. There's the debt. Subtract. And I'm going to divide by the shares to get stock price. So I did that real quick, but I mean, you have it just to the left of you. It's the same thing over and over again. Yes, Alex.
So looking at multiples, you're high coding in the multiples. Wouldn't it be more efficient if you link it directly to the precedent transaction?
So I just said that. I just addressed that.
No, but I'm saying as a general, like, do you have to? You rounded it up. Was like,
Yeah.
is that what they do in practice?
Yeah,
or,
yeah. Yeah.
So you know,
Yeah,
like,
yeah, we just talked about that. So some people, there's a couple ways to do it. Some people link it in. Usually we'll look for a range, yeah, I just kind of talked
okay.
about it. Yeah. It's in there. So we'll do it again for 16 times. Same formulas. Multiply. Subtract to get equity value. And divide to get the implied stock price. So as you're working through it, this is giving us an expected valuation of $108 to $149. That's pretty high. And, probably ridiculously high. I mean, yeah. I mean, listen, this was 2007, different market environment. Before, you learned about everything Bear Stearns with Julio. It was before all that happened. Valuations were completely different. Again, one flaw of the analysis highlights different environment, different market environment. People aren't paying these prices anymore. I don't know if anyone would pay that price, even especially for a $250 billion company. But we're going to look at all these three analyses in their entirety a little bit later. Okay. Discounted cash flow, kind of to what Alex was asking. Couple things we can do. Let's go to the Dcf analysis. I'm going to take the 8847 as the low and the 9634 as the high. Some people build out sensitivity tables based on the most common variables. If we have time, we'll look at how to do that today. If not, we'll look at it tomorrow to extrapolate. And I would probably recommend that more. I just didn't do that in the book because there's just a lot of explaining. And you can also look at it on a multiple basis. I could have had down here, instead of equity value per share, I could have had implied enterprise value multiple and then got a range like I did before and kind of round the range. So for this one, I'm going to start with 8847 as the low and 9634 as the high. So I'm going to go over to the football field and do low 8847, high 96. Okay. You could have just linked it to what Alex was saying, just different ways, 96.34. Reason why people kind of round a range is just because you'll see how general this is going to become. And a lot of those multiples swing based on the market. So there's a lot of other things that go into it. Your understanding of the market, your understanding of the industry, aside from just the technicals. So a lot of times your model helps with the range, but isn't the definable end-all in calculating the range. But now we have to do this backwards. So we got to go from the stock price down to the multiple. Okay? So what do? What's the first step?
Shares outstanding.
Multiply. Real simple. We'll take shares outstanding and multiply. We're going backwards now. Then what? Debt. And we add this time. Add the debt. And then EBITDA. And now we divide to get an implied multiple. Okay? You guys all right? And take your time, and I'll just pause for a second, but take your time to do the same thing on the high end. Okay? And divide. So real tight range, 10.1 to 10.8. And notice that it's on the high end of the comps analysis. So looking at all these together and how one reacts off of another, we're going to talk about. But I'll give it a couple seconds just to make sure you have that. Okay, and then something else I like to do, not everybody does, but is just look at what the 52-week high and low was to see historically where has the stock been. And that'll help us identify, is it trending upwards, is it trending downwards? It's a frame of reference. So the 52-week high and low you can get from Yahoo Finance. It's right in the front there. Here it's $56.30 and a high of $77.60. So 56.3, and 77.6. That's the low and the high. And like what we did for DCF, we got to just take this and back calculate into an implied multiple. Okay? Take the shares outstanding, multiply. Take the net debt, add. Same thing that we did with DCF. Take the EBITDA, divide. Okay? So I'm going to do this real quick, but I'm going to give you guys a little time to get through it. Oops. Oops, I subtracted, I should have added. Okay, and then here I'll show the formulas for some of you guys that might want to see the formulas. What does this mean? If you scroll down, everything is laid out in a floating bar chart. Okay, and we just have to reposition this dotted line. This dotted line is manually inputted to be, obviously, if the current value is $73, it's got to be below 73 is probably about, this is 77, 88, probably about here. Okay? So this is where it's trading now. And so the question is, what does it mean? Okay, so let's look at these. So if you scroll down, are the headers here? Okay. So you can see historically they're trending up. They're at a peak. And actually, when I put together the book, when I wrote the book, the stock was at like 56. It was at an all-time low. And I ran the analysis, and the bars, no matter how I looked at it, the bars were way above it. So like, this is a no-brainer. The stock's going to go up. But then I wrote the book, and the stock had already gone up. So now it's like I had to change my whole perspective. Now we're kind of stuck in this limbo stage where it's kind of in the middle, which makes it more difficult. Back then it was easy, no-brainer. But this helps give that frame of reference. You can say, oh, okay, so they're kind of coming up from a downward trend, right? How would you look at this? How would you interpret this? The line, which is where they are now, is at the low end of the comps range. No surprise, because we said that Walmart was trading at the low end of the range, right? What about precedence? How's that look? Yeah, it's lower than precedence. Precedence is high. And actually, investment banking interview question is, of the three methods, what always shows is the highest. Precedent transactions is always the highest. Why?
Because companies usually pay a lot more premium.
Includes a premium. The premium is baked into the value, the numerator of our multiples. The enterprise value, the market value is really based on a purchase price, usually includes a premium. Could be 15% premium, 25% premium. So we expect the precedence to be high. This is a little extreme though. But what about DCF?
Higher as well.
It's high? Yeah. How would you conclude this in terms of where Walmart's stock would go?
Just like what you had said in the book, the Walmart stock would go up based on the valuation methods.
Yeah.
Trading at a lower end of comparable.
Yeah.
DCF is, the valuation via DCF shows that the Walmart stock is undervalued.
Mm-hmm.
Same goes with precedent transaction.
Mm-hmm.
And then you can probably pick a range to be very specific and say it could be anywhere from 57 to 140 now is a long shot, but based on DCF, you can even say 88 to 90.
Yeah. I mean, listen, you guys have to, there's no right or wrong answer here now. You have to kind of play these off each other and try to kind of draw a conclusion as to where it's going now. So, and you got to know, you have to know, and this is why I stress on, and a lot of times you're asked, you got to know the benefits and the flaws of each analysis to help your case here. I mean, the comps is accurate in that it's based on the last price change it traded. It's what a stock investor would actually value the companies at. So this holds a lot of weight. Present transactions, okay, I'd almost throw this away because we knew this is 2007. This is a poor market environment.
Plus chances of Walmart getting acquired by someone
Plus
else.
chances of Walmart getting acquired is very low. Discounted cash flow is based on our model. So if your model is conservative, this is a good indicator of where the company would be. Now remember when I spoke about the difference between the perpetuity and the EBITDA methods, and if they're far apart, what that would mean, right? One's based on the market and one's based on the model, right? You can apply that here. If your DCF is way higher than the comps, right? Maybe your model is super aggressive, right? Maybe you overestimated your projections. If you didn't, maybe the market is undervaluing your company. And like I said, back in 2009 when we used to do this, and back before we had this school, I went to company and valued their businesses. Hands down, every single company. The DCF was up here and the comps were way down here because the multiples were low. Nobody wanted to invest. And those are buying opportunities. And if you look at them now, it's reset. It's balanced out to like this or maybe even like this. So you can identify good investment opportunities there. So when you look at the DCF, there's a couple of questions you want to ask. You want to say, okay, well, this is kind of based on my model. Is my model accurate? Is it conservative? If it's super conservative, it's a good indicator. And if it's in line with the comps, these are good indicators. The only concern that you might have is it's a big jump from their already 52-week high. So where are they going to go? And actually, if you want to know, it actually popped up. It went up to just about 89. And then it's slow, sort of hovered there, and now it's at like 64. Now it dropped again. But since then, they've restated earnings. Earnings have gone down. If you rebuilt the model, you probably would have a more negative picture.
How did you do that? In the book, you have a boundary of stock where you value the stock to be somewhere between here and here. How did you come to that number?
I basically did this. The one other thing I did was I looked at the DCF in a bit more detail because I said, okay, well, what are the variables in my model, and if those in my DCF, and if I adjust those variables, what would happen to the stock? And it actually looked like the stock would drop. So what I said in the book is, I said it's going to go up to about 89 and then start dropping, and that's exactly what it did. So let me show you that now. So this is where extrapolating the DCF into variables. So let's go over to the DCF. And as I told you, we took the simple approach to the DCF where we just took the low and the high from the different methods. But you can use, we can adjust the major variables to see what flexibility we have in this analysis here. Okay, so I'm going to create a variable table. I'm going to create a two-variable data table. A two-variable data table illustrates how the output would change if major variables would adjust. So for example, looking at the EBITDA method, what are the major variables that drive the EBITDA method? The uncertain ones.
Major variable that drive the multiple, first of all.
The EBITDA multiple, big one. We just took the last 8.7. We noticed that that's the low end of the range. What happens if it goes up, right? What else? Of what? That's perpetuity. We're talking about EBITDA method. So the multiple, and what else? What's the other variable? The WACC. The WACC.
How would I get the WACC is a very major part of it, but how would it be so drastically different?
Let's see. What within the WACC is the biggest variable here?
Beta?
Yeah. Yeah, if we look at this, risk-free rate probably not going to move so much. Market risk premium is pretty static over years, really. Cost of debt, maybe. It's the beta. The beta wouldn't jump around. Okay. It could be 0.3, it could be 0.5. I think when we looked it up, it was very different when we looked it up for today. That's the big variable. So we can have a two-variable data table with multiple by WACC this way. I usually do it, but you can actually even go multiple by beta. But let's see. So in other words, I mean, I could just say, all right, well, if the multiple is 8, what would the price be? If the multiple is 11, what would the price be? But there's a better way to lay this out. I'm going to show you. first thing I want to do is I'm going to put a header for the table. Sensitivity. I'm going to do EBITDA method sensitivity. Okay, that's the header. And to the right of that, I want to link in from the model to illustrate what I want the table to be populated with. I want the table to be populated with varying share prices. Bless you. So I'm going to link this in. Top left corner. So actually, okay, this is I'm gonna bring this down a level because it's gonna overwrite or override my header here. Just a formatting thing. So this is the way these variable tables work. You want to link in from the model what we want the table to be populated with, and the table we want populated with varying stock prices. Okay. To the right of that, we want one set of varying, one set of adjustable variables. So let's say the WACC. So the WACC is now 5. We could do 5, 6, 7. Do 5, 7, 9. I don't know. I mean, let's see. If the beta, I didn't believe the beta was going to go down anymore, but it actually did. If the beta went down to like 0.3, then the WACC goes to 4.5. If the beta went up to like a more standard 1, then it goes up to 8. I don't think it would go above 1. So I would say 4.5. I would say 5. 4.5. I would do 5, 6, 7, 8. Whatever.
So with the beta,
5, 6,
will
7,
that
8.
change according to market conditions as well? So if
It's based.
if something becomes bullish, it becomes a higher.
Yeah, it's based solely on the stock prices.
Still
Yeah. So I would do 5%, 6%, 7%, 8%. That's what I would do. Okay. And underneath that, we'd adjust the multiple. Now, given our comps ratio is 8 to 11, let's use that range. I'm going to go 8, 9, 10, 11. And I'm going to do my custom formatting to make it 0.0x. These are hard codes, so I'm going to make them blue. And just let me know.
We're doing the multiple on the left, right?
Yeah. Yeah, that's awesome, Cortez. Cortez is saying Break Into Wall Street has a good tutorial on how to create a football field chart, but we're going to have someone come in and teach you guys how to do that if you want. Yeah. But you can look at the tutorial. I didn't know. I want to look at that too. That's pretty cool. Somebody had a question? Oh, wow. It's really leaking. It just happened? It's so weird. Well, maybe it's a lid. Okay, once we have that, highlight everything, including the top left corner. You don't have to highlight the header. Top left corner, highlight everything. Then we go Alt-DT, I think, is universal. Alt-DT. Otherwise, if you have different Excels, you might have to navigate differently. You can go to Data, What If Analysis, or some people have Data Table, and then Data Table, or Data What If Analysis, Data Table, or Alt-DT. If anyone cannot find it, let me know. Oh, there's a lot of there's Macintoshes, Apples. No matter what you find, when you find it, you'll get everyone gets this box popping up. Okay? Everyone have it? Now what this is saying is, it's asking for where to go on the model to adjust the row. So it's basically saying, okay, well, I see the variables or the percentages across the row. Just where do I go in the model to get that, right? Because basically what this is trying to do is it's trying to say, okay, well, I want to, once I highlight everything, I want to kind of go in there and, you know, maybe you make an adjustment to the percentage. Where would I go for that?
So look at the row, you go to the WACC calculation.
The WACC calculation. Does that make sense?
To the discount rate.
That make sense?
And then look at,
So it's basically saying, okay, well, I see the variables along the row, but where do I go in here to adjust? So, yeah. You guys got it? You okay? How about the column cell? Oh, where did I get this? Oh, you didn't get it? Alt DT. Try that. Alt DT. Just tap Alt. Yeah, tap Alt. Not that. D. Just hit the D. Yeah, you're good. You're good. Just tap it. Yeah. Okay. And then D. Tap it. And then T. There you go. Yep. Yep. Sure. And then you want to select, yeah, F17. And then column input cell is up and down the column. Alex, I don't know if you had solved it, but where do we go?
you go to the
Multiple. The multiple. And then you hit OK, and this is what you should get. Varying dollar amounts. I want to go in there and I want to adjust it. I want to make sure everyone gets it because a lot of times it doesn't come up properly. I'm going to change this to currency. And let's look at what this is saying. The range can go either way. The range could go, I don't know how to demonstrate this. The range can, the range can go expand this way, up and down, and then when it start to overlap with the PPaids and overlap, or it could just expand up, or it could just expand down. And when I did this extrapolation process, and you can even see the table, 96 is about as high as it's ever going to go, it looked like this was dragging down. The more I extrapolated the variables, the range brought this down further, which kind of made me more skeptical about the stock price potentially going up. So that's why I kind of said, well, this 88 is going to be like a ceiling, and then it would eventually go back down. Or so, and I wouldn't expect, that takes a lot of time to kind of get the know-how and the comfort. But just, you know, from a mechanical perspective, it's good to know how to do it. Let's do it again for perpetuity. Perpetuity method. So we're going to type in perpetuity method. Okay. Again, linking in from the model, what I want the table to be populated with, which is the perpetuity method price, the 9634. Okay. To the right of that, what are the variables after perpetuity?
Growth rate and WACC.
Growth and WACC. To the right, I'm just going to link in the same WACC percentages from above. I'm just going to go equal to above. Up to the right, you can do that. Okay. And the growth rate, now the growth rate is relatively static, 1%. I'm going to say, all right, well, what if it's 0.5%, 1%, I don't know, 1.5%. I don't even think it's going to move that much. Okay. I'm really more concerned about how the WACC impacts it. Okay. And again, highlight everything. Alt DT. Okay. Guys all right? Alt DT. Row input cell is
Whack. F16. I'm 17%.
the whack, F17. Column input cell
F27.
is the growth rate. And so this is showing major drop in the dollars. So we're at what? We're at 96.34. That's somewhere between here, but amazing how significant the drop is for each percentage. So this is what kind of confirmed for me that maybe the stock price is going to go down a little bit.
Could go down a little bit. What was that last sentence?
Yeah, could go down.
Because it's assuming that 1% perpetuity.
Yeah,
right?
yeah.
What tells you that the stock will go down? Yeah.
The increase in the whack. Right, this is where it drops. Yeah.
And that was one of your assumptions, right?
Mm-hmm.
That beta would go up.
Yeah, when would beta go up? And that's obviously in the future. If there's more volatility, in the stock, then later on it'll go down. And that's what happened.
Sorry, explain that again, sorry. Like, so if your stock, you're saying, like, you looked at two numbers and then you can draw a conclusion about that.
Mm-hmm.
Yeah, what do you mean, sorry?
Sorry, where are you hung up on?
Yeah, like what Drew's point was is that you looked at 77.46.
Uh-huh. Yep.
Saying that the stock price would drop.
Yep, because I just noticed how significant the WAC's impact on the stock price is. Look at the drop from 5 to 6% of 177.
Yeah.
So I said any hint at an additional increase in volatility would bring that stock down. That's the way I thought about it. Now, how do you know that the stock's going to increase in volatility? That's where the guesswork comes in. But see, we're taking a bunch of variables and narrowing it down to one instance and narrowing down the guesswork. I mean, that's the idea, and that's the kind of art to this, which will take a lot of significant time. But that's the way I looked at it.
Would there be any, apart from these two, these two types of sensitivity analysis, would there be other variables that you could possibly sensitize?
In the DCF?
Well, yes, if you like, all the whole model, yeah, all the whole model.
Oh, you can sensitize. Have some fun with it. Just do multiples, just have tables, pages of tables, growth rate.
You can probably sensitize anything that would
cash, cost cutting, more, and actually, I like the question that you're asking. It's going to hold. It's going to have more of an impact when we do M&A and LBO, and I'm actually going to list all the variables and kind of narrow it down, especially when solving answers to cases. You got a case going on. But growth rate, revenue growth, the COGS and the OPEX percentage of revenue, getting to EBITDA is going to be significant because EBITDA is a big driver of this. Okay, so you can do sensitivities on what happens if I underestimate my growth. My average growth rate isn't 6%, but it's 5% or 7%. Okay, what happens if cost of goods sold, what if they drop a percentage, right? Or they face market external pressures and it goes up a percentage. These are the things you'd want to say. How does that trickle all the way into here?
Even stuff you can sensitize, sensitize like synergies and things like that.
Yeah, and we'll look at all that. I mean, synergy doesn't take place here, really, in a standalone, but we'll look at that in the LBO too. Yeah, anything that drives these numbers. Depreciation is probably going to be pretty static. Deferred taxes is probably going to be pretty static. CapEx. What if CapEx goes up a percentage? What impact will it have on your valuation? These are things you want to look at. Good question. I'm glad you're thinking that way. Okay? So this kind of more or less concludes the valuation of Walmart. Obviously, I want to spend tomorrow, let's see, I want to do one more valuation to prep you guys for Monday. I think I'm going to continue to have the test on Monday. I think it makes sense. I think you guys are prepared for it. We'll be wasting a week if not. So I want to try to prep tomorrow. If we have more time, we can kind of start to look at what we're going to look at in the transition period. I mentioned to you we're going to transition into M&A. So we're still going to use this model, bless you. I want to talk about raising equity, raising debt, buying assets, divesting assets. These are standalone analyses that serve as a bridge or a seed into M&A, right? You're not acquiring a big entity, you're acquiring small entities. Let's talk about how that moves. So we'll start to introduce that tomorrow if we have time. If not, spend next week on that. Monday's the test. Next Tuesday we'll focus on raising equity, raising debt, what impact that has. Wednesday on acquiring, divesting assets. And then Thursday, I'm going to try to get the guest speaker to come in and talk about, pepper in kind of a couple sessions. One, his analysis on Monster, how he used this to see a good investment opportunity. Great presentation. And then two, I want him to come in and talk about the football field and things like that. So we'll kind of maybe Thursday, and then the next week we'll do another one. So we still have those topics to learn as we ease into M&A, and then we'll go right into M&A, focusing on mini merger model, practicing like we did the DCF mini merger model. I want to make sure you guys can talk about it really well, and then getting into the full scale model, Office Deep, Office Max. That's going to take a good 4 weeks until March. Okay. I will see you tomorrow.